Welcome to Behavior and Risk, where we explore the intersection of decisions, the brain, uncertainty, and the business world. I'm John Burkhart.
And I'm Rich Loria.
We're glad you took a chance on us today.
Hi, welcome to Behavior and Risk. Archegos was a family office founded in 2013 and based in Midtown Manhattan. It was run by Bill Hwang, formerly of Tiger Asia. Tiger Asia ran into problems during the Great Recession, with Hwang paying $44 million to settle insider trading charges brought by the Securities Exchange Commission during his time there. After returning outside investor money and closing down Tiger, Hwang decided to apply the lessons learned and open Archegos using only his own money, which is the definition of a family office. Hwang decided to run Archegos much like he ran Tiger Asia. He utilized a consortium of 6 banks to provide extensive financing to support Archegos operations. The 6 banks consisted of Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura, Deutsche Bank, and UBS. The banks regularly permitted Archegos to provide $1 of collateral for every $5 to maybe even $8 of funds that he borrowed. The use of multiple banks allowed Hwang to play one bank off the other in negotiations and obtain what he needed financially, even if 1 or 2 banks initially rejected his demands. The banks were largely unaware of Archegos' dealings with the other banks. Archegos initially employed a borrow and go long equity strategy in a highly concentrated portfolio of companies. However, the fund decided to go even further by subsequently deploying total return swaps to amplify its exposure to these companies without either increasing its equity position or borrowing more from the banks. Archegos paid a flat fee on a given notional amount, and in return, the counterparty bank would pay the total return on the stock or basket of stocks selected. The use of total return swaps allowed Archegos to hold high equity stakes positions without actual asset ownership. The actual stocks were held by the banks to offset their short position in the total return swap. Hwang was also known to utilize a distinctive interpersonal management style in his business dealings. In meetings, he was well known to ask a probing question and then sit back and absorb the information provided by the bank executives. While he regularly met with other fund managers to discuss investing ideas, he was often ambiguous and vague when discussing what his plans were. While he communicated regularly with his team, he often withheld information from them, only sharing what he believed they needed to help Archegos succeed. Hwang made all the final investment decisions for the fund. Hwang was also a devout Christian, and that played a significant role in his interactions. He often commented favorably when someone would wear a crucifix as an adornment. He donated profits to the Grace and Mercy Foundation, a nonprofit grant-making organization he founded back in 2006 to provide grants to theological seminaries and Christian-based charities. He was known to live a very modest life, despite his vast wealth. The combination of leveraged equity investing and total return swaps in a limited number of companies, a very concentrated portfolio, led to very outsized gains for Archegos for many years. Since funds were all provided by Hwang, he decided to reinvest in these same positions, further increasing the stakes in these same handful of companies. Furthermore, Archegos had no requirement to disclose any of its holdings for regulatory purposes because of the filing of the company as a family office, which were excluded from some of the significant regulations in Dodd-Frank. Limited disclosure requirements for family offices combined with low actual equity ownership due to the extensive use of the total return swaps kept Archegos off the radar. Banks had no major concerns as long as Archegos maintained collateral requirements despite sometimes questioning the amount of leverage being deployed by Archegos in certain individual transactions. In March 2021, Archegos was estimated to be worth $20 billion after starting out with only an investment of $200 million when Archegos was founded in 2013. Much of that came from the total return swap positions, fueled by a run-up on the underlying stocks that were part of those swaps. However, fortunes turned on them, and Archegos wound up receiving margin calls from the banks. This forced Archegos to sell some of those same stocks to raise cash, which led to a spiral, a price spiral. This downward draft resulted in the fund no longer being able to satisfy the underlying margin calls. Hwang tried to resolve the situation through negotiations, but to no avail. The banks summarily began a fire sale of their holdings in the underlying stocks in an attempt to limit their losses. Nevertheless, the markets roiled as word creeped out about the potential collapse of Archegos and the underlying contagion to the banks that were part of the transactions. The family office was estimated initially to have lost $20 billion in a span of only 48 hours. The consortium of banks supporting Archegos also were losers in this, suffering losses of roughly $10 billion combined, with Credit Suisse and Nomura being the biggest losers. This led to the firing of chief risk officers at a number of the banks, including at Credit Suisse. Following this rapid debacle and bankruptcy of Archegos, regulators got involved, including investigations by the SEC and the Department of Justice. In November 2024, Bill Hwang was ultimately sentenced to 18 years in prison for 10 counts of securities fraud, wire fraud, conspiracy, racketeering, and market manipulation. The judge in the case actually compared Hwang to Sam Bankman-Fried and the FTX situation. Witnesses from the case included 2 former employees of Archegos. And the underlying source of Hwang's guilt was his deception of the banks and misrepresentation of Archegos positions. John, I'm not sure exactly where to start. Where would you like to go with this?
This is a curious one because superficially, this doesn't really seem all that different in kind from any number of collapses that we've talked about or that we see around us. A hedge fund manager, or in this case, a family office manager, makes some curious decisions, and then there is a cover-up and collapse. Fairly garden variety. But this particular case, I see lots of different dynamics, lots of different things that are occurring that are very interesting from both a risk and behavioral perspective. There's Bill himself. Rich, you and I have had this ongoing conversation about why does bad behavior happen? And I think this is an instance of somebody who really should know better and did know better and did engage in, by all standards, fairly overt malfeasance. There's dynamics of why do assets collapse and how do they, when looking at the ViacomCBS share value back in March 2021. There's the dynamics between the banks and how they ultimately decided or did not decide to cooperate when realizing the exposure that they faced. And then there's also just the notion of total return swaps and how risk perception around them emerges. And while these things all interact, the fundamental questions and issues around them are, I think, a little unrelated. So this is a fairly complex case because there are so many different foundational elements that contributed to it. Yeah, I don't know where to begin with this. What's a good narrative? Do we want to talk about Bill or do we want to talk about the banks first?
Let's start with Bill Hwang and the fact that he comes from a hedge fund background, that he was part of the whole Tiger group. He was a Tiger Cub, groomed by Julian Robertson, who is well known as a hedge fund titan who was incredibly successful and wound up bankrolling Hwang's initial foray to develop Tiger Asia. So my thought on that is from a behavior standpoint, if you have somebody who is a rock star, who is telling you, yeah, you're great, I'm going to put all of this money and I believe in your ideas and what you're doing, that is going to foster quite a bit of overconfidence. And we tend to be overconfident to begin with.
It plays into a lot of what we've discussed in the past about, yes, overconfidence bias and representativeness as well. This is what somebody who is successful is supposed to look like. But there's also some interesting elements of reinforcement in that. We've talked about this in our discussions of groupthink, and it's not confined strictly to groupthink that when somebody we like or somebody that we feel some affinity towards or even aspiration towards, somebody who we want to be like, tells us something that we want to hear, that becomes very reinforcing. We don't want to say, no, I think you're wrong. We don't want to not go along with them because that diminishes that affinity. If we go back to the work of Dr. Robert Cialdini, he's spoken extensively about how affinity with people is a very powerful driver of choices and decision making. And so I think that is a really key element here, as you point out, this sort of rock star maverick who is, from everything we've read, seems to have had a charisma or at least mystique about him that people wanted to aspire towards or be part of or have some adjacency to. Yeah, I think it makes a lot of sense that he was able to drive people to give them his money or make concessions or deals that, from a purely objective standpoint, they probably shouldn't have done.
And I wonder a little bit about his management style. And I'd like you to address this, John, because Hwang was certainly not alone. I've certainly witnessed people in my career who hold the cards to themselves, who will not share exactly what they're thinking, who will often remain silent in the room and just absorb what's being said by others and will not necessarily confide very much in those that are closest to that decision maker. And I'd like you to address a little bit from a behavioral standpoint, what would drive someone to take that kind of approach?
In terms of taking that approach as a leader
As a
or
leader, yes, as a leader and also as an interactor with other parties that you're negotiating with.
I see a lot of reasons why somebody would do that. We recently recorded an episode. I don't know if it will be published by the time we publish this one, but we recently recorded an episode around sociopathy and how that interacts in the risk and business space. Looking at Bill and individuals like him, I think maybe we should record an episode around cult leaders and how they go about establishing the influence that they exert. This is a little bit tongue in cheek, but not entirely, because I see a lot of parallels, that sort of unknowingness and that quiet, unshakable confidence and that sense that I know how things are going to unfold. I know the best way forward. You should trust in me. There are a lot of parallels with what we see with cult leaders and other very charismatic religious leaders. And this plays on, I think, a few different things. One of the big ones is information asymmetries. When somebody holds information, or more importantly, if we believe that somebody holds information that we don't, we tend to listen to them. We know that people as a whole tend to be averse to uncertainty. We don't like not knowing what the future holds. We don't like not knowing what the best choice or best course of action is. If we believe somebody holds information that we do not, and that they are far more likely to see the true path forward, yeah, we're very likely to go along with what they suggest. And this is, again, something that has been spoken of in neuroscience circles and behavioral economic circles, even just in pure management circles, that information asymmetries are very powerful in negotiations, in setting prices, in any sort of transaction. Going back to something as simple as car sales and real estate sales, the traditional models of these rely upon information asymmetries. The entire broker-dealer model assumes that the consumer does not have the same level of information that the broker, seller, or dealer does. Once you resolve that asymmetry, then there's really no need for these brokers and dealers and sellers to have the position that they do. Markets are still a very unknowable space, or at least for a casual participant, they are a very unknowable space. If you're willing to devote your life to it and sleep 4 hours a night, sure, you can know them with as much certainty as anybody else, let's say. And I think that's a big part of why Bill did what he did, why he embraced the management style that he did. I need to emphasize, I don't know him. I've never interacted with him. I'm going entirely on what I infer from sources that I've read. But it certainly seems as though he cultivated this aura of quiet knowingness, almost a Confucian figure or Socratic figure of, I'll let you ask questions or I'll ask a question to draw out the truth, but I already know what the answer should be. And that instills confidence. That instills confidence and a certain level of trust in people who work with him and listen. And so I think it was probably very intentional, that leadership style that he displayed.
That's interesting. Going back to our other episode on sociopaths, what about his holding his cards close to the vest in dealing with other banks, dealing with other fund managers? It seems almost as if the picture I get in my mind, John, is of somebody at a poker table in Las Vegas holding their cards literally close to the vest.
I think we probably need to separate these out because the holding the cards close to the vest with people who he's taking money from, I mean, this is something he did even before Archegos was set up as a family office. This cultivates and maintains that information asymmetry. If people have too much of an idea of what he's doing and what he's going to do, then there's not nearly the need to work with him. We see really the diametric counterexample to this in Warren Buffett, who from the first day he spun up Berkshire Hathaway has been fully transparent in how he conducts his stock picking, his asset picking, his valuation. And we see very little in terms of people who are duplicating or following along because, well, it's not sexy. There's no mystique to it. It's very well defined and everybody knows how to do it. Just as an interesting aside, this is irrelevant to the Archegos case, but Buffett has famously been quoted when asked, why don't more people follow your investment approach? Responding as, because nobody wants to get rich slow. But I think that's a big part of why Hwang had this tendency to keep his cards close to the vest. It maintained and cultivated this sense that we should go with him. We should go along with what he suggests because he knows something that we don't. When it comes to the banks, I think this information asymmetry is definitely a factor, but I think there's an additional, probably even more profound and important driver that is manifest here, which is this was misrepresentation. The Archegos case specifically was overt misrepresentation. And if he didn't play his cards close to the vest or keep his cards close to the vest, the banks never would have gone along with this. So information asymmetry, yes, but also just lying. And I think that's really what we have to call it based on everything we've seen. This was overt lying about what his percentage of assets were, what his holdings were, and what the investment strategy were. If he had been honest about this, he never would have gotten these TRSs written and underwritten.
Yeah, I think there was definitely a conscious effort to not disclose certain positions because, to your point, a good number of these total return swaps would never have happened. I also find it interesting, and at the risk of potentially going down a rabbit hole, I want to talk a little bit more about this whole information aspect. Because on the one hand, Hwang clearly wanted to limit the amount of information that others, even including those who were close to him, had about what he was planning to do. Yet on the other hand, he seemed to have no issue with taking information that maybe he shouldn't have had access to. And this goes back to his Tiger Asia days when he settled with the SEC for insider trading. He seemed to have no qualms about taking information and leveraging it to his advantage. So for someone who's very devout and from all accounts seems like a good guy. I mean, again, neither of us know him. We've never met him. And I'm not trying to make a judgment one way or the other. It's an interesting contrast how someone who demonstrated such generosity in so many ways in other aspects of his life with regards to information wound up being very selective, very, I would say, greedy with regards to that, wanting to keep all the information for himself. And it kind of lends itself to where things are going with regards to information in general. And the fact that today we have so much more access to information, and that even modern day physics, some of the biggest physics problems have to do with concepts around information and the transmission of information. But now I'm going down a rabbit hole.
It's an interesting rabbit hole to go down. And I don't think there's really any contradiction here. I think that if you're going to leverage information asymmetry, the easiest way to do it is to have more information than anybody else. It's important to point out here, you don't actually need to have information to leverage asymmetry. You just need to create the perception that you have information that other people don't have. But if you actually do have more information than everybody else, then you do have additional value. You can create results and outcomes that other people are not able to easily do. You're able to detect patterns other people are not easily able to do. And you can honestly and accurately say that, yes, I have access to this knowledge, this information that you maybe don't, and I can work with this to make all of us winners here. Regarding the ubiquity of information, it's an interesting space because, as you pointed out, access to information in general is becoming far more omnipresent to casual lay users. Observing what's happened to the real estate broker career and profession over the last 20, really not even 20 years, 10 years, is fascinating because that's a particular sector that relies entirely upon information asymmetry, the assumption that the brokers have access to databases and pieces of information that buyers do not. And that's no longer true. And if you talk to enough real estate brokers when they are perhaps somewhat inebriated, there's a growing sense of panic of what do they need us for anymore? And I think Wang was trying to probably insulate himself against that. Markets are moving in that direction. They aren't there yet. There's definitely a lot of time before this level of information density is available and digestible to the everyman. But I think we're no more than 10 years away from that. And in a lot of ways, I think he was probably making hay while the sun shined.
That's an interesting point. And in particular, I like your point about it's not so much whether you have more information, but whether others believe that you have more information that can drive behavior that can be to your advantage.
Yeah, every time we're talking about really any financial product or transaction, perception is foundational. We like to think that these should be objective, that we should be able to process them and evaluate them, if not purely quantitatively, at least fully objectively. But truth of the matter is, financial transactions are odd beasts, and all of them are driven by layers of belief. This, to your point earlier, could go down quite a rabbit hole regarding just notions of money and belief in value. I think that's probably its own episode sometime in the future. But there's no way of setting up a two-sided financial transaction without belief and perception being foundational and fundamental elements in terms of what the ultimate value of the transaction is determined to be. And forget that at your own peril, because there are lots of people out there, such as Wang, who know this to a intimate degree and are capable of leveraging it in a way that most people are not really familiar with or aware of.
Yeah, and that gets back to chapter 7 in our textbook. For those of you out there who have purchased it or considering purchasing it, that's a chapter where John and I talk about leveraging bias and the constructive ways of using it, but also with warnings and caveats that leveraging bias, leveraging the behavior of others, knowing and anticipating how others will behave if you put certain information or withhold information out there, it can be used for malintended purposes as well. Or at least maybe if not malintended, certainly grayer types of usages.
I won't say can be used. I will say it has been and is used all the time. Historically, we call this marketing.
That's quite cynical, John, but let's not go there. Okay, switching up gears a little bit. I wanted your thought about Hwang's investment approach because it's actually a pretty simple approach. The total return swap is just sort of a really to the extreme manifestation of a time-honored and well-worn investment strategy of I'll borrow money from X, add it to a small amount of my own, and then go long in what I really believe in. And that's effectively what he did. And there's nothing unusual. There's nothing, I would say, particularly complex about it. I think all of our listeners can understand that strategy. And furthermore, he just invested in what I understand to be very select number of issues, very select number of issuers, I should say. So why do you think he wound up investing in just a small number of companies and that he stuck with those companies through thick and ultimately thin? My thought was that maybe there could be some aspect of Miller's Law here, but I wanted to get your thoughts on whether you believe maybe I'm going off track with this.
I think that's by and large accurate. Something that I think is very important to point out here for just the overall Archegos case scandal, bankruptcy, and subsequent criminal actions is that if ViacomCBS never went down, it's very likely this never would have been discovered. There was nothing overtly problematic about his investment approach in the legal or oversight sense. His investment strategy was simply, to your point, we'll take these TRSs and invest them in areas where we think there is long return. There's no Ponzi scheme involved here. There's no robbing Peter to pay Paul. There's no overt malfeasance on the part of the investment strategy itself. It was just lying to get that initial value put in place. Of course, when you look at TRSs, especially when you have multiple TRSs from multiple vendors, all on the same underlying asset, you are effectively leveraged to the nth degree. And so if he wins, if he makes the right call, he makes a ton of money, and the people who issued those TRSs go home very happy. But that's, of course, not what happened. And of course, now there's a multifold loss, and everybody is left holding the bag because there is so much leverage involved here.
It's more than just the leverage, although the leverage clearly is what brought everybody else into it, including those 6 banks who were providing the leverage. It's the concentration, right? So you mentioned more than once about ViacomCBS. I believe that if he had more diversification, and I don't think he had to have a lot more diversification, I think he just had to have some, that it would have offset some of what was going on and would have, at least to some degree, neutralized some of the leverage that he was using. So again, I go back to, wow, being so concentrated in a relatively small number of companies. And at one point, I think he had something to the effect of 10 billion in notional value in Viacom through the total return swap. That's just an astounding number. And I just wonder if there was something to the nature of, I'm just going to focus on these handful of companies. They have certain characteristics. And from what I understand about Hwang's strategy, he was very much a fundamentalist at part, meaning he did fundamental equity analysis on the companies that he made these bets on. Not unlike what you would hear from a Warren Buffett. Because again, Warren Buffett largely does fundamental analysis. That's his thing. You do fundamental analysis on companies and then you make stakes in them. It's just the nature of the stakes and the fact that Warren Buffett will still have a pretty diverse number of holdings in his overall portfolio.
In answering this, I am forced to try to read the mind of Hwang. So bear that in mind and take this with however many grains of salt you feel is appropriate. I think that to the broad question of why did he not diversify? Why was he so focused and concentrated on these handful of assets? The briefing I have in front of me shows that largest holdings were ViacomCBS, Discovery, and a handful of various Chinese tech stocks. And these over time represented anywhere between 40% to 98% of the capital under management by Archegos. So yes, huge concentration. I think it's probably a measure of buying his own hype regarding the information asymmetry. He probably believed, and perhaps genuinely did, know something more about these particular assets than the average person, and believed that he could effectively play these particular assets. I think what's interesting is what was positioned to the banks was that the top holdings were supposedly Alphabet, Amazon, and Microsoft, no particular asset exceeding 35% of total capital. And with this level of TRSs involved and the effective leverage engaged, if he had gone in that direction, would have made a ton of money. Anything that would have yielded just market or slightly above market would have been phenomenally profitable. But I think he probably believed his own hype, and the classic mistake that virtually every failed investor makes is he got greedy. He could have made a ton of money by taking the same approach with more secure, stable assets. But he didn't want to make a ton of money. He wanted to make a metric expletive ton of money and thought that he could do so by going after these particular assets. And yeah, the greed gets in the way. The greed always gets in the way. Now, I think this also is interesting because we get to notions of why do asset collapses happen? I come back to ViacomCBS repeatedly because that seems to be what kindled this whole collapse. And coming back to notions of perception, you pointed out that Hwang was a very fundamentals-based investor. The initial decline in ViacomCBS was not fundamentals driven. It was purely perception driven. This is something that I have maintained for a long time, that fundamentals do not create major swings in asset values. People create swings in asset values. ViacomCBS had no real change in any of its operations, in any of its revenue. It simply issued a new round of stock. And investors thought, oh, this is a bad sign. This means something bad. Therefore, we're going to reduce our positions. Hwang just happened to be caught in the wrong place at the wrong time, having so much of his assets concentrated within ViacomCBS, such a high degree of effective leverage. And then once the banks got hold of this, I think we were going to get to this very shortly, the sort of prisoner's dilemma that emerged among the various banks. This rapidly fueled a genuine collapse from which I was looking at the share value today. It's really never recovered.
Yeah, those are all good points. And in particular, I think this gets to prospect theory and something that I just taught again in my class last week. And the notion of not everybody fits the prospect theory curve. And clearly, in my mind, Bill Hwang did not fit in the gain domain, the prospect theory curve, because under that theory, which again, by and large, many people do follow, folks become risk averse with regards to gains, and that once they have a certain amount, they're not going to risk it to try to get that megaton amount of wealth. That at some point, I'm good where I'm at, and I'm not going to continue to roll the dice. So what I think we see with Hwang, and this certainly happened, I believe, on both ends, is that he's risk positive in both domains. Because even as the losses started coming in, he was still trying to obtain more capital. He was still trying to get more out of the banks because he really believed in his positions. And if he just had more time, that those positions were going to come around.
He definitely displayed risk positive behavior. That I will give. Now, this comes back to something that we've talked about. And for those of you who've not purchased our textbook yet, shame on you. But we do talk about in our discussions of risk appetite that risk appetite emerges as a consequence of a few different factors. There is risk preference and risk perception. There's something that's known as the entrepreneur's dilemma. It's assumed there's this colloquial notion that entrepreneurs, founders, people who run startups are adrenaline junkies who are seeking the thrill of every high risk chance that they can take. Empirical studies show this is probably not really correct. It's actually much more common that these sorts of individuals have highly skewed risk perceptions. That is to say, they believe the odds are more in their favor than they actually are. They don't have any greater risk preference than a typical individual. They're just optimistic. And so I think it's very clear that Hwang engaged in risk positive behavior, but I'm not sure it's necessarily we can conclude that he had a risk positive preference. He might have just had a skewed sense of the probabilities. And if we go to the overconfidence, I think you can make a pretty compelling case. That's probably why these decisions were made.
That's interesting. We will never know the answer because we don't know him, and we would have to see how his decision making played out in other parts of his life. But I do think you bring up a good point that it very well could be that his perception of the underlying risk was much lower than those of the market. And I think that clearly played out.
And I think that as somebody who clearly valued knowledge or perception of knowledge, I think it's very likely that he was overconfident, that he probably believed he knew far more about the future. His crystal ball was better than the rest of the world's
Yeah.
to an extent that was very likely unwarranted.
But we've seen that again and again, right? There are studies out there that show overconfidence of managers all the time. So,
Absolutely, yes. I also want to just throw a quick note here, which is to your point around prospect theory. Yes, it is built on population averages. It is not a characteristic model that describes every individual out there. It's here's what the average person in the population will do. Or really more correctly, here's what aggregated across 8 billion individuals, the decision-making behavior we will see will be. There are absolutely circumstances that can lead otherwise median or mean individuals to engage in more risky behavior, very tightly associated with dopaminergic activation around uncertainty, around intermittent reinforcement, around fluctuations in gain or loss. That is definitely its own episode.
hmm,
But again, I want to emphasize that you don't necessarily need to be a risk positive individual to end up participating in risky decisions. There are other things that can make that more likely. And I think that is something we definitely should talk about at some point in the future.
so what you're saying is that someone's risk preference is contextual. It really depends on the specific circumstance as to whether they display the prospect theory curve or not.
Yeah, I think that's definitely a correct way to look at it. I don't want to go too deep down this rabbit hole because that could be hours of conversation, but whether or not you've recently experienced a loss, what the magnitude of that loss is, what your baseline is, all of these things affect the probability around your next decision.
Point taken. I think we should turn now to the banks, because we've been talking about Hwang for quite some time. So let's turn to the banks because, again, it takes two to tango, and I would say in this case, maybe even more than two to tango. What are your thoughts around why there wasn't more due diligence of Hwang? What do you think possibly contributed to their working with him so closely, providing effectively such high amounts of leverage, despite admitting in some cases that they were somewhat uncomfortable with certain transactions?
I have a lot of thoughts around this. I know you and I differ to some extent around what we perceive as the most causative elements here. I think that the fact that this was a family office rather than a hedge fund, rather than a large scale investment group, probably contributed a great deal. There's a degree of representativeness that takes place where a family office feels small. Now, clearly, this was not a small office. If we're talking about how many billions under management did he have, but nevertheless, it seems like the downside exposure is limited with a family office. How much can you really lose? And towards this, I think also that the structure of the total return swaps contributes to this because, and this is, I know, where you and I start to diverge a little bit. So I'll offer my thinking and I welcome your pushback on this. I think that total return swaps play havoc with traditional notions of mental accounting. With a total return swap, because there's no real change in ownership of the underlying asset, it feels safer on both sides of the transaction. If you're the person receiving exposure to the asset, it feels like, okay, this is just an opportunity for me to play with. I don't actually have exposure to the baseline value. Therefore, this is a safer opportunity for me. If you are the person granting access to that asset, or in this case, the banks, there's this sense that they can do whatever they want with this. We still own the asset, and that limits our downside exposure. Now, as we've discussed, objectively, these are both incorrect positions. Objectively, the exposure is, you could argue, even greater on both sides than a typical transaction. But it feels safer because, well, there's no change in ownership. Now, this creates a lack of endowment on the part of the person receiving exposure to the value. They don't own it, and so therefore they are less inclined to be careful with it. And the banks themselves are likely to exercise less due diligence. And I don't want to specifically say the banks. I want to say whoever is granting access to the asset is unlikely to display the levels of due diligence that they should because they're not actually parting with the asset. And yeah, I think this creates a greater propensity for inappropriate decision making on both sides of the transaction.
So that's interesting. So you're coming at it from the standpoint of endowment. And while I agree with a lot of what you said, I would also suggest that some of this has to do with the underlying simplicity of the transaction. A total return swap is something that I think most individuals can understand at a basic level. So I think the fact that these transactions are relatively straightforward and do not require exchange of assets at the outset allows them to be transacted very quickly. You can just sign on the dotted line. And as long as you provide the basic minimum collateral requirement, which is a fraction of the amount of notional amount that's involved here, then you're fine. And as long as you continue to make those margin requirements as the transaction moves one way or the other, as the underlying stocks involved go up or down, then you're good. So one aspect I wanted to talk about a little bit more with the total return swap, one other aspect of it has to do with mental accounting. And the tendency with a swap transaction to potentially separate the different components of it, to separate the actual notional swapping of amounts from the underlying payments back and forth in terms of the fee versus the total return. And I just wanted you to address a little bit about that and whether you think that also plays into some of the additional comfort that the banks and perhaps even Hwang himself may have felt as this transaction was moving along.
I think that absolutely was a factor. The structure of total return swaps makes it very difficult to do any sort of accurate mental compartmentalization or categorization of the assets, of whatever sort of return you're getting on them, and whatever kind of downside exposure or volatility you have on them. And I'll be honest, I'm not even certain myself what the appropriate compartmentalization of this would be, because while they are superficially a simple asset, a simple transaction, the financial dynamics of them are fairly complex. And let me clarify. If you are the bank and you have written this TRS to Bill Hwang, I don't even know how you appropriately categorize or separate out the shifts in just the share value of the underlying asset from the shifts in whatever you've written to Bill versus the fee or percentage or premium that you're collecting along the way. I'm sure they have written down a formula for this. I hope to God they have written formulas for this. But in terms of just evaluating them mentally, keeping track in your head as things fluctuate and emerge, I think that's phenomenally difficult to do. And as we know, very often when things are difficult or complex, we tend just to not think about it. And I think that makes it much easier for the banks to probably have gone in far deeper and far longer than they probably should have in this particular case.
Those are great points, John. And I think this plays into something that you and I have talked about a number of times, which is the concept of bundling, and that in fact, derivatives in and of themselves, including swaps, which fall into the category, really leverage bundling. And the fact that banks are able to sell a whole package of transactions into just one particular transaction that encompasses all of them. And the tendency is, to your point, that once you've entered the transaction is to just look at the underlying bottom line. How much is being transferred at a given moment? So what's the value of the underlying stocks? What's the fee involved? Just looking at those exchanges, what's the collateral call? Which end is it coming from? Just keeping those things simple. But underneath the swap are a number of different things being swapped. That's why it's called a swap. There are amounts being swapped. It is, in effect, replicating what Hwang was doing before he started entering these things, which is borrowing from the banks and then investing long in stocks. So what the swap manages to do is to bundle that composite of transactions into one streamlined transaction.
And I think you can make an argument that this is probably central to how Hwang was able to get himself into such a problematic position. I think that there was probably an overutilization of the isolation effect. This is something that, if for those of you who are not as familiar with prospect theory, is an observation that people tend to calculate or contemplate single discrete transactions, single discrete calculations, rather than looking at the emergent complex whole of a more complex situation. In this case, exactly as you just described, the aggregate value slash revenue slash exposure slash impact of these TRSs, especially when they are drawn from multiple banks and have an aggregated leverage that creates additional impact on the market, means that you really can't effectively evaluate these as single transactions. I look back at the brief I have here, and there's just this sentence that really grabbed me. A sharp decline in ViacomCBS's share price following a stock sale triggered a cascade of margin calls. The complexity and the aggregate impact of all of these holdings was far greater than I think was ever actually calculated out. I don't think they were ever doing the full risk calculation of, all right, what happens across the board if we see a swing downward? And I think that's a failure of isolation, or not a failure of isolation. I think that's overutilization, rather, of the isolation effect, resulting in a failure in risk decision making.
And I want to tie this back to something that's been talked about in the literature with regards to another failure, which is the Great Recession of 2008 and the subprime mortgage crisis. This was on somewhat of a smaller scale than that particular crisis, but in effect, it's a lot of the same thing. You had multiple banks who were providing a lot of leverage and taking one side of a particular transaction, and none of them knew or had very limited knowledge of what any of the other banks were doing. So this was a combination of what's referred to in the literature as an information systemic risk failure, as well as an incentive systemic risk failure. The information part we've already talked about at length, so I won't cover that again, but I do want to get to the incentives. And it gets to a really problematic thing that I think regulators and those who are concerned about another major financial crisis where everything gets stuck again as far as the flow of financials and access to capital could occur, which is that individual banks themselves, frankly, don't have any incentives to worry about what other banks are doing. So they're just going to do their own transaction. They may have a model for it and what can happen in certain things, but they're not linking in how other triggering cascading effects could occur if there are similar exposures at other banks. And that's largely because they don't really have the incentive to know, or at least the incentive to dig deeper.
They don't have the incentive to know, but I think this also occurs in part because of one, the isolation effect we were just describing, that what you're putting forward is a very complex calculation. And I think this dovetails with something which is until recently, and arguably even now, probably not entirely, actually calculating something that emergent is virtually impossible. There's really not a good way to run those computations with real numbers because that would require access to full knowledge of the holdings and positions and strategies of other banks as well. And one, there's all kinds of confidentiality problems around this. And two, just purely from a computational standpoint, how many God computers would you need to be able to run this in real time?
I agree and I disagree. I agree that it is a complex calculation, but I also disagree in that if the banks were aware of these other exposures at the time, they could have done some type of stress test that looked and said, okay, if this occurs, well, we know that this counterparty has exposure to these other banks as well. These other transactions are going to go through the same thing. We could at least try to put some rough guess on what could happen. Admittedly, it would not be one that I would place a lot of faith in, but it could at least give you an order of magnitude. And again, that gets to the whole purpose of stress testing. Could it give you an indication that you've really got a problem here? So let's pivot to one other aspect regarding the banks, which is eventually they did find out about each other. Because once things became dire, once ViacomCBS issued that additional stock that really drove down its value, which then wound up resulting in severe margin calls by all the banks on Archegos, they all came to the table, right? Because Archegos couldn't satisfy those margin calls, had nowhere to turn, and really had to turn to the banks and say, hey, look, can you work with each other here as well as with us, to work through this. So I just wanted to get your thoughts about the whole situation that played out with regards to the banks that came to the table, and then ultimately the fact that two of the banks, Morgan and Goldman, who had probably the least exposure to Archegos, wound up just deciding to unwind. They said, hey, look, let's just cut our losses, get out of here. And that wound up leading to a cascading effect that eventually led to much bigger losses that were suffered by Credit Suisse, who are now part of UBS, of course, as well as Nomura.
Yeah, this was a really interesting thing in terms of just the dynamics of how it unfolded. The banks were faced with a dilemma, which was, of course, how do we preserve our wealth, preserve our capital as best we possibly can? In terms of the best aggregate decision for all of the banks, the smartest thing to do would have been a gradual unwinding of the ViacomCBS assets to slowly sell it off over the span of 12 to 24 months so as to not create any significant downward pressure on the share price. If one of them were to spontaneously dump all of their holdings, that would, of course, create enormous downward pressure, which then creates more reason for the other banks to get rid of their assets as quickly as possible. And this creates even more downward pressure, and so on and so on and so on. And you have basically a collapse in share price. Of course, the first bank to do this, the first one out the door, recovers basically all of their value. So this was a prisoner's dilemma. The classic prisoner's dilemma is, of course, you have two prisoners who are each offered a deal. If both of them take the deal, they receive lower impact. If neither of them takes it, they get some, again, symmetric impact. But if one of them takes the deal and one of them refuses it, the one who takes the deal gets almost no negative impact, and the one who refuses the deal gets hung out to dry. This is, in broad terms, what the banks faced. And what we saw here was exactly as you pointed out. It was Morgan Stanley and Goldman Sachs who just decided, you know what? There's not really any reason for us to cooperate. We don't care if these other banks are kept whole or how much they lose. We're going to keep our bag as intact as possible. And so discussions essentially broke down, and Morgan Stanley and Goldman Sachs divested entirely from ViacomCBS. And this, of course, then led to that downstream cascade. Nomura and Credit Suisse were the last out the door, and they got pennies on the dollar back for their holdings there. This is interesting because a prisoner's dilemma is, when you look at it from a behavioral economics standpoint, there's a very clear decision. You always walk away. The behavioral economics, the loss averse point of view should be that you don't take the deal, that you look out for yourself, because on aggregate, that's going to protect you best. And that's exactly what we observed here. The interesting part to me is that when you look at the criminal justice system, very often you don't see this play out. Very often you do see that people who are charged refuse to cooperate with the legal authorities, even though on aggregate, it's not in their best interest to refuse these deals. And I was thinking about this. I was thinking about this as we were preparing for this episode. And what I suspect, my hypothesis here, is that this is around uncertainty. This is around how confident are you in the other party's decision in this transaction. In the case of the criminal justice system, the classic prisoner's dilemma is that you have two individuals who were both participating in the same criminal enterprise. They were collaborators, they were partners, and now they're being faced with this decision. And this, by implication, means they probably know each other. They probably have some degree of history with each other, trust, maybe, maybe not. I mean, we're speaking of a purely hypothetical case here. But there is some reasonable level of certainty that the other individual is not going to take the deal. And so therefore, you are confident by not taking the deal yourself. In the cases of these banks, what I thought of was that there's no way of knowing whether or not the other banks are going to cooperate. There's no legal enforcement. I mean, I suppose you could write a binding contract for the next 2 years that you not divest by more than 10% in any given month, and that would be enforceable through lawsuit, I suppose. But it doesn't have the full force of legal weight that you would expect in the criminal justice system. And this creates uncertainty aversion. This creates a scenario where neither bank really knows what the other is going to do, and we don't like uncertain decisions. When we aren't sure what to do, we tend to go to our status quo or default or established behavior. In this case, an asset value is in a downward spiral. The default behavior is you get rid of that asset. And purely in terms of self-interest, this is not the sort of thing where we were looking at a global contagion event where, the economic system might collapse and it'll throw it into a recession. There are several $billion on the table. Yes, we'd like to preserve as much of that as we can, but if other banks lose $10 billion, it's not going to create a recession that impacts our bank as well. So yeah, I think it makes sense that this unfolded as it did, and I've rambled extensively there. So what are your thoughts there?
Yeah, I think you bring up a great point about the uncertainty and the familiarity. So when we're dealing with those that we have familiarity with, there's a comfort that comes in. There's a sense of predictability about how they're going to act, and we'll factor that predictability into what we do. I also think it's telling in terms of what the message is from an expected utility theory and prospect theory. And something that I espouse, and I know you espouse as well, is that certainly when you are making economic decisions, we encourage folks to use expected utility theory. It's the right thing to do. What we also recommend is that prospect theory be incorporated into expected utility theory with regards to making predictions of how others will behave. And in this case, the only sensible prediction that could have been made is that everybody is going to be running for the doors. And therefore, you should run for the door and hopefully you'll get there first.
It's funny. I didn't think of this until just now, even during our preparations, but in this particular prisoner's dilemma among the banks, we see another instance of this problem of information asymmetry. You don't know what the banks are going to do. All you know is what's on the table for you. And
Yeah.
this means that you are at a disadvantaged position in plotting out what is the best choice for you. And so, yeah, I agree that in terms of the evaluation of the landscape based on information available, made sense that they acted as they did. And while we would like to say that, oh, it's the more responsible thing to do for them to cooperate, and this preserves more wealth across, not only themselves, but also investors and ViacomCBS itself. Yeah, but that ignores basic human decision making.
It ignores the whole incentive issue that self-interest comes into play, and their self-interest is towards their shareholders and making sure that they minimize any potential damage from this situation to their owners.
We like to wrap up these episodes with take homes and lessons for what can we observe from this to enhance our own risk practice or protect ourselves when making decisions. And a lot of the classic lessons I think apply here, which is, examine the motives of the people you're transacting with, make sure you understand the full structure of what you're getting into, do good due diligence. That's become kind of garden variety at this point. What really strikes me in this case, as we've mentioned repeatedly now, is the power of information asymmetry. We see this on so many elements of this particular collapse and subsequent criminal prosecution. And that's what I take away from this to a degree I wasn't expecting when we first started looking at this case, that information asymmetry can both lead you into positions that you probably shouldn't be taking, and can cause external actors to make decisions that are maybe not the most productive on aggregate. So if you were to ask me what's my lesson from this particular case, it would be resolve information asymmetry as best you possibly can anytime you have a complex or high stakes transaction. I don't know that it's realistic that you will ever know just as much or more than everybody else involved in a transaction, but minimize that gap as best you can. This is going to normalize your own decision making to a far greater extent, and it's going to reduce the amount of leverage and influence that other parties have over you and your own decision making.
And I'll just add that in our analysis of this, information asymmetry has come to the forefront, and information asymmetry is nothing new. In fact, the Securities Exchange Commission was created, and the whole notion of disclosures and 10Ks and all of these things that are out there, prospectuses from mutual funds, these are all available today because of the recognition that investors need to have better information, because there is an information asymmetry between those who are putting together a business plan and asking for capital versus those who are seeking to invest the capital. So these disclosures provide somewhat of a narrowing of the gap. And in terms of our audience and decision makers out there, it is just one more reminder about the importance of due diligence to try to mitigate against deal lust, and that sellers of potentially attractive properties will leverage the information asymmetry in order to try to extract as much value from a particular transaction. And it's really up to the buyer. So we talk about buyer beware all the time, to obtain as much information as possible while recognizing that there's always going to be a certain amount of uncertainty with any particular transaction being contemplated. So please make sure that you keep the notion of information and the importance of information in mind as you operate your businesses and as you make strategic decisions. All right, we wish you all well, and we'd love to hear from you as far as your thoughts about information in the business world, especially as the cost of information becomes cheaper and cheaper, and the ability to leverage an information gap becomes more and more challenging in different businesses and different professions.
Behavior and Risk is brought to you by Capita Solutions. Behavior and Risk staff includes our research team, Sherry Xu and Jin Zhang, and our editing team, Qingying Gao and Athena Liu. Theme music by Crypt of Insomnia. The opinions presented here are solely those of John Burkhart and Rich Loria and do not represent those of Columbia University, Capita Solutions, or any other organization. We thank you for taking a chance on us today.